Listen closely, because what I'm about to share isn't theory, and it isn't prediction. It's observation, market behavior, as it actually unfolds on the tape, in the charts, and in the quiet footprints left behind by the interests who truly drive price. And before we go deeper, let me tie today's discussion to the previous video on Richard Wyckoff, Trend Mastery, Follow the Market's True Direction, because what we covered there about understanding the market's path is the foundation for recognizing when that path is about to change. Now, when I speak of smart money, I don't speak of mysterious characters behind curtains. I speak of large, persistent interests who accumulate and distribute positions carefully, methodically, and always with a plan. The public may chase the excitement, but these larger operators require time and structure. And whenever a major trend reversal is approaching, there are clues, subtle at first, then increasingly clear to the trained eye. Have you ever sensed the market shifting, yet couldn't quite articulate why? That is exactly the experience I want to help sharpen. You see, a trend does not reverse simply because price has moved too far or traders believe it should. The composite operators reverse their positions only when their campaigns, accumulation or distribution, have run their proper course. And if you learn to read the signs of that transition, you begin to understand the rhythm of the market in a way most traders never do. Does that sound like something that would give you more confidence in your decision-making? The first clue often appears as a change in character. The market may be rising, but the quality of the rise weakens. Spreads narrow. Volume begins to behave abnormally. Strength appears where it shouldn't, or weakness appears where the structure doesn't support it. I always encourage traders to ask, is this action typical of the trend I believe I'm in? Because if the answer is no, that alone tells you to pay attention. Many traders ignore these signs because they appear subtle. But has the market ever whispered something to you that you later wished you had listened to? These early changes in character often show up in a familiar place after an extended move where the public feels most certain. At the top of a long advance or the bottom of a long decline, traders are often convinced the trend will continue indefinitely. Yet the very confidence they feel is a reflection of how fully the composite operator has completed their campaign. When the public becomes comfortable, the larger hands become cautious. They lighten positions, test supply or demand, and probe for weaknesses. Don't you think it's revealing that the market often behaves most deceptively right when traders feel safest? The second clue emerges when we see tests. Tests of the highs in distribution or tests of the lows in accumulation. But these are not just any tests. They are purposeful examinations of the market's ability to continue in the current direction. Think of them as the operator knocking on the door to see who's still home. A rally back toward previous highs with diminishing volume is not a sign of strength. It is the market telling you the interest to buy at those levels is drying up. And in accumulation, if price dips toward prior lows yet volume refuses to swell and sellers fail to show up, what does that tell you about the true underlying supply? These tests reveal whether the path is clear for a reversal. They reveal whether the operator can proceed, and they are visible to anyone willing to observe without emotion. If you catch yourself feeling anxious during these moments, ask yourself, is this anxiety coming from what I see on the chart, or from what I fear might happen? The disciplined trader learns to anchor decisions in observation, not emotion. Somewhere around this stage, you may notice the principle we discussed in the previous video. Richard Wyckoff, Trend Mastery, Follow the Market's True Direction, quietly coming back into focus, because understanding the true direction of the market is precisely what allows you to recognize when that direction is beginning to shift. Without that foundation, these clues would seem random. With it, they become a narrative. The third clue is the emergence of a genuine shift in supply and demand. Not just a temporary reaction, not just a momentary pause, but a true demonstration. In distribution, it might appear as a sign of weakness, a decline with wide spreads and increasing volume, telling you supply is finally asserting itself. In accumulation, it might appear as a sign of strength, a rally supported by expanding volume and decisive price action. These signs are no accident. They are the beginning of a new campaign. Have you ever noticed how the market seems to reveal its intentions only after most traders have stopped paying attention? Now let me make something clear. These clues do not guarantee a reversal. Nothing in markets is guaranteed, but they significantly increase your understanding of the probabilities, which is the closest thing to an edge a trader can seek. By recognizing these signs, you avoid blindly following the crowd and instead align yourself with the interests who write the script of the market's movement. And this alignment is not just technical, it's psychological. A trader must cultivate patience, discipline, and a willingness to observe without forcing meaning onto the chart. Many traders try to predict the market because prediction feels empowering. But have you ever considered that the real power lies in reading what the market is already saying? When you study smart money behavior, you begin to see that every movement has purpose. Accumulation is not rushed. Distribution is not impulsive. Tests are not accidental. The market speaks in patterns because the operators behind these patterns have objectives they pursue consistently. And as traders, our task is to join them, not fight them. Wealth building and trading is not about catching every move. It's about catching the meaningful ones. The ones aligned with the campaigns of the larger interests. It's about waiting for those times when the clues line up, when the structure supports the shift, when the character of the market tells you a story you can trust. And isn't it interesting how the more patient you become, the less you feel the need to chase? Because once you learn to recognize these three clues, change in character, purposeful tests, and signs of strength or weakness, you begin to see the market as it truly is, a place where structure precedes movement, where footprints reveal intention, and where the trader, who can read those intentions, positions themselves long before the public realizes a reversal has begun. A shift in market character is often the earliest and most reliable clue that smart money is beginning to reposition, and understanding this shift is one of the most valuable skills any trader can develop. When I speak of market character, I'm not referring to a single candlestick or an isolated volume spike. I mean the overall behavior of price, how it moves, how it pauses, how it reacts to supply and demand. It's the personality of the trend itself. When that personality starts acting differently, you can be sure something beneath the surface has changed. And if you've ever watched a chart and felt that something just didn't look right, that feeling was your intuition catching the first sign of this shift, long before your conscious mind understood it. Every strong trend, up or down, has a certain consistency. In an uptrend, you'll typically see healthy demand showing up on reactions, strong pushes to the upside, and orderly consolidations where volume dries up before another run begins. In a downtrend, supply appears easily, rallies are weak and short-lived, and breakdowns tend to occur with a kind of heavy conviction. But when smart money begins to prepare for a reversal, whether it's distributing at the highs or accumulating at the lows, the market stops behaving the way it normally does. It becomes uncharacteristic, it loses rhythm, and if you're watching carefully, you'll notice these changes well before the general public catches on. Imagine an uptrend that has been moving steadily for weeks. For a while, everything behaves as expected. Price makes higher highs with decent volume, reactions are shallow, and demand consistently overpowers supply. But then something unusual happens. Price pushes to a new high, yet the effort behind that move appears weaker. The spread narrows. Volume is lighter. The push feels forced, not natural. This is the market whispering that the composite operator has slowed down their interest in moving price higher. They may not be distributing aggressively yet, but they're no longer supporting the trend with the same enthusiasm. In Wyckoff's language, we call this a change in character. It's not a reversal in itself, rather, it's the first signal that the environment is shifting. And it's often the clue that separates traders who get caught in the turn from those who prepare ahead of it. If you've ever wondered why some traders seem to step aside right before a major move against the trend, it's usually because they're sensitive to these early signs. You'll see this same loss of character at market bottoms as well. In a downtrend, price typically falls with wide spreads and strong volume, followed by weak rallies that fail to show meaningful demand. But eventually, the behavior changes. You get a decline that doesn't travel as far as it should. Volume dries up instead of increasing. Spreads narrow where they normally expand. Sellers suddenly seem absent. These moments look small on the chart, but if you study them deeply, they show the fingerprints of accumulation. It's important to understand that smart money does not announce their intentions. They do not reverse a trend abruptly unless the entire structure is ready. They begin slowly, almost subtly. They taper off their buying near the end of an uptrend, letting the market float upward on thin volume. Or in a downtrend, they absorb supply quietly without creating a dramatic shift in price. This is why a change in character is so informative. It gives you the earliest window into their shifting posture. Many traders make the mistake of waiting for something dramatic, a giant candlestick, a major collapse, or a powerful rally to confirm a reversal. But by the time that happens, the professional interests have already built or closed the bulk of their positions. They acted earlier, in the quiet phases where the market was whispering instead of shouting. If you've ever felt like your entries were always late, it's likely because you were reacting to the obvious rather than observing the subtle. A change in character might reveal itself through time as well. For example, the market may begin to move sideways for longer than usual. Rallies may take more effort. Declines may lose momentum. Volatility may contract after being consistently wide. These are all signals that the dominant force in the market structure is shifting from trending behavior into preparation behavior, and preparation is always followed by something meaningful, either continuation or reversal. The skill lies in identifying which. To notice these subtle shifts, you need to train your eye not just on the price, but on the relationship between price and volume, between effort and result. If the market expends significant effort, but produces a weak result, that's a clue. If it produces a strong result on little effort, that's another clue. These disparities are often the first footprints of smart money, moving quietly in the opposite direction of the public. And as you continue building your trading experience, you'll realize that change in character is not a single moment but a progression. It evolves over time. It keeps nudging you, testing whether you're paying attention, asking whether you're reading behavior or merely reacting to price. This is why so many traders overlook it. They want certainty, not subtlety. But the market rarely hands out certainty. It offers clues, footprints, and hints. Your job is to learn the language in which those hints are written. When you observe a market that begins behaving in ways it hasn't behaved before, when it hesitates where it once pushed strongly, or pushes where it once hesitated, you are seeing the earliest signs of smart money shifting its stance. Volume behaving, out of place, is one of the clearest and most telling signs that something beneath the surface of the market is shifting, and when you learn to recognize it, you begin to see the motives of smart money long before the average trader even suspects anything is happening. Volume, in many ways, is the market's voice. It tells you how much participation there is, who might be active, and whether the effort behind a price move matches the result. When that voice sounds different, too loud when it should be quiet, too quiet when it should be loud, you can be sure there's more going on than the chart alone might suggest. In a healthy uptrend, volume tends to expand on rallies and contract on reactions. That rhythm makes sense, because buyers are dominant, they show strength on the advances, and sellers step aside during pullbacks. But imagine you're watching an uptrend that has been climbing steadily. Suddenly, on a rally to new highs, volume shrinks dramatically. Price may still rise, but it rises without the kind of commitment you've come to expect. This is volume behaving, out of place. It's the market telling you that demand is not as enthusiastic as it once was. If you've ever seen a price push to a new high and felt uneasy instead of excited, that feeling likely came from noticing, consciously or not, that the volume didn't fit the story the price was trying to tell. Sometimes the opposite happens. You get unusually large volume during a place where you'd normally expect the market to be quiet. For example, during a routine pullback in an uptrend, volume should diminish as traders take profits and wait for the next advance. But if volume suddenly surges during that pullback, what does that tell you? It suggests that supply is present, real supply, not just casual profit taking. Someone with size may be unloading positions, and the larger interests never unload casually. They wait for moments of liquidity, and when they act, the volume they create stands out like a flare in the dark. But it's not just the size of the volume that matters. It's the behavior relative to what the trend has taught you to expect. Most traders fixate on the bars themselves, but the real insight comes from comparing today's action to yesterday's context. If volume shows strength when the trend suggests weakness, or weakness when the trend suggests strength, it means the balance between supply and demand is changing. These imbalances are early footprints of smart money repositioning. In a downtrend, for instance, volume typically increases on declines and fades during rallies. The pattern makes sense because sellers dominate the environment. But if, during a decline, volume suddenly dries up significantly, that's unusual. It indicates that sellers aren't as active as they once were. The downtrend may continue for a bit out of inertia, but something is beginning to shift. You might not see a reversal right away, but you're seeing the first signs of demand quietly absorbing what's left of the selling pressure. Then there are moments when a downtrend experiences an unexpected spike in volume on a rally. This doesn't always mean strength. Sometimes it's simply short covering. But other times, that sudden burst of activity reveals the early steps of accumulation. Smart money often uses rallies in a downtrend to test the market, and the volume generated by these tests provides valuable information. If the rally occurs on increasing volume after a period of declining volume on sell-offs, it tells you buyers may be stepping in with more enthusiasm. You'll also encounter situations where volume spikes dramatically but price barely moves. This is one of the most deceptive forms of out-of-place volume because it confuses newer traders. They see the heavy volume and expect a large directional move, yet the price goes nowhere. What does this mean? It indicates absorption. The composite operator, those larger interests with real size, is absorbing the aggressive pressure coming from one side of the market. If price is at resistance and heavy volume appears without progress to the upside, that often signals distribution. If price is at support and heavy volume appears without further decline, that often signals accumulation. These moments reveal strong hands taking the opposite side of weaker participants, and they frequently occur before major turning points. Another important aspect is the timing of the volume. Volume occurring early in a move carries a different meaning than volume showing up late. High volume at the beginning of a trend can be healthy, as smart money establishes positions, but high volume near the end of a trend can be a warning sign, often reflecting the public entering enthusiastically while the larger operators quietly exchange positions with them. Have you ever seen a chart where the biggest volume of the entire trend appears right before the market reverses? That's not luck. That's distribution or climactic action. Even the absence of volume can be revealing. When the market reaches a key level, whether a high or a low, and volume is unusually absent, it tells you the interest from traders is fading. If price attempts to break support but volume remains weak, that weakness can signal exhaustion rather than continuation. The public may interpret the breakout as a continuation, but smart money interprets the lack of commitment as a sign the move may fail. Recognizing volume that appears out of place is ultimately about understanding the normal rhythm of a trend and noticing when something disrupts that rhythm. It's a skill built through observation, repetition, and quiet study, not prediction. When you train your eye to identify those moments where volume doesn't match the story price is telling, you begin to catch the earliest signs of major shifts in the market's underlying forces. And if you've ever wondered how some traders seem to sense reversals long before they happen, it's often because they've learned to listen to the parts of the chart most traders ignore. Tests of previous highs or lows reveal whether supply or demand is truly present, and once you understand how to read these tests, you begin to see the market with clearer eyes. A test is not just a price retouching a level. It is a deliberate examination of the market's internal strength. Smart money uses tests the way an engineer taps on a structure before stepping onto it. They want to see if it will hold. They want to know whether the crowd still has energy in the previous direction or whether the move has exhausted itself. To the casual trader, these retests often look insignificant, but to anyone who studies the behavior of price, they are moments filled with information. And if you've ever wondered why certain levels seem to attract price again and again, it's because these levels are where the truth is found. In an uptrend that is nearing completion, you will often see price return to previous highs. The market pushes upward and challenges the level where buyers had shown strength before. But the question isn't simply whether price can reach the high, it's whether it can rise above it with conviction. If price touches or slightly exceeds the previous high, but does so with weaker volume, narrower spreads, or less urgency, that is a failed test. It means demand isn't supporting the advance as it once did. Smart money observes this carefully because it hints that the upward campaign may be nearing its end. To understand why this matters, you have to consider how the composite operator behaves. They need the market to show its hand. If they intend to distribute, they want to know how much buying pressure is left. A test of the highs allows them to see exactly that. If the public is still eager to buy, price may push higher with strength. But if the public hesitates or volume dries up, the operators know the environment is ripe for distribution. These moments reveal whether the ground beneath the trend is firm or hollow. In a downtrend, you see the opposite. Price returns to previous lows to test for remaining supply. When a decline nears exhaustion, the market frequently dips back into the lows to see whether sellers are still aggressive. If price approaches the low and volume remains light, that tells you sellers are no longer pushing with force. If the market dips slightly below the low but immediately snaps back, it shows absorption, smart money quietly taking in what little selling remains. This behavior often marks the early stage of accumulation. Now, what makes these tests so challenging for many traders is that they often look like continuation patterns. A test at the high might be mistaken for a breakout. A test at the low might be seen as a breakdown. This is why understanding context is essential. Breakouts supported by conviction behave differently than breakouts created to test demand. You might see a small, hesitant push above a previous high that fails to follow through. You might see a temporary move below a support level that quickly reverses. These are not continuation. They are exams. And if you train your eye to distinguish between genuine movement and testing behavior, your understanding of the market becomes far more sophisticated. Volume plays a major role in interpreting tests. Strong breaks above resistance with expanding volume show buyers are committed. But breaks above resistance with contracting volume reveal hesitation. In a similar way, breaks below support on heavy volume signal aggressive selling, while breaks below support on weak volume suggest exhaustion. Every test has a story written in the relationship between price and volume. Another important feature of tests is how quickly the market responds after the test is complete. When price tests a high and immediately reverses with strength to the downside, that reaction tells you the test revealed weakness. Smart money saw what they needed to see and acted. Likewise, when price tests are low and rallies sharply after the test, that reaction signals underlying demand. The strength of the response is often more important than the test itself. You will also notice that tests often occur after climactic behavior. For example, after a buying climax in distribution, the market may react downward and then return to test the high. This secondary test is critical because it shows whether the climax was an exhaustion of demand or merely a pause. If the retest shows significantly weaker demand, the distribution structure strengthens. Similarly, after a selling climax, price may rally and then retest the low. If sellers don't reappear with force, accumulation becomes more likely. Smart money frequently uses tests to fool the public. They understand that many traders view breakouts and breakdowns mechanically without considering volume or context. A test that pushes slightly above a previous high may lure breakout traders in just as the composite operator begins selling into that false strength. These false breakouts, often called upthrusts, are classic examples of how tests reveal the reality behind the move. The same is true in downtrends, where a slight push below support can trap traders going short just before price reverses sharply upward. Tests also help traders understand the psychology of the crowd. When price returns to a previous level, traders who missed the earlier move often act emotionally. They jump in without considering whether the market conditions have changed. Smart money studies this behavior because it shows how eager or fearful the public is. Every test exposes sentiment, commitment, and vulnerability. Perhaps the most important reason to study tests is that they bridge structure and timing. You can know that a trend is aging, but without a test, you won't know whether the key players have confirmed their bias. Tests provide the confirmation. They reveal readiness. They prepare the path for reversals. And if you've ever watched price reverse sharply after a quiet, almost insignificant retest of a level, you've witnessed firsthand how powerful these moments can be. When you learn to observe tests with patience, watching the effort, the response, the volume, and the context, you begin to understand that markets turn not because of luck, but because key levels reveal the truth about supply and demand. Failed tests often precede major reversals initiated by composite operators, and understanding this single concept can transform the way you read charts. A failed test isn't just a setup gone wrong. It's the market revealing where true strength or weakness lies. A test fails when the market attempts to revisit a previous high or low, but cannot confirm the strength needed to continue. It's a moment where the market shows its hand, even if most traders aren't paying close enough attention to see it. And if you've ever watched price tease a breakout only to snap back violently, you've witnessed the power of a failed test in real time. To understand why failed tests matter, you need to recognize how smart money evaluates the environment. When a trend has run its course, the larger operators don't simply reverse direction suddenly. They probe the market. They push it toward key levels. Prior highs in a distribution phase or prior lows in an accumulation phase, to see whether there is enough enthusiasm from the crowd to sustain the move. A successful test confirms the trend still has energy. A failed test reveals that the energy is fading more quickly than most expect. Consider an uptrend that has been moving steadily. The market approaches a previous high and smart money wants to know, is there still buying pressure at these levels, or has demand weakened? So price nudges toward the high, perhaps even poking just above it. Traders who rely purely on breakout strategies jump in eagerly, but instead of expanding, volume remains thin. Instead of surging upward, the spread narrows. Instead of follow-through, price hesitates. Within a short time, the market reverses downward, sometimes sharply. That moment, where the breakout fails, is the failed test. It signals not only that demand is insufficient, but that smart money may have used the test to offload some of their own inventory into the enthusiasm of the latecomers. This pattern occurs just as clearly at market bottoms. In a downtrend that is exhausting itself, price pushes into a previous low. Sellers anticipate further downside and often act aggressively without paying attention to volume or character. But the composite operator is watching closely. If the push into the low shows weak volume, shallow penetration, or immediate rejection, it means sellers are not truly present. The test of the low failed, not because price couldn't break it, but because the anticipated supply never appeared. Instead, smart money quietly absorbs what little pressure remains. This failed test becomes the first real sign that the downtrend has weakened and accumulation is underway. Now, failed tests are extremely significant because they often reveal the moment when the previous dominant force, buyers in an uptrend or sellers in a downtrend, has finally been absorbed, exhausted, or stepped aside. This exhaustion is critical. Trends don't reverse because enough people hope they will. They reverse because the dominant side has run out of power. A failed test is the clearest evidence of that shift in power. If you've ever felt confused by sudden reversals that seem to appear out of nowhere, It's usually because you didn't see the failed test that came first. A failed test is also a demonstration of effort versus result. The market makes an effort to break a level, effort shown through the price movement itself, but the result is weak. In Wyckoff terms, the effort-result relationship becomes imbalanced, revealing that the side pushing price does not possess true control. Imagine price pushing toward a previous high. The effort is there, the candles rise, the market inches upward. But the result is lacking, there's no momentum, no volume increase, no extension. That imbalance is the hallmark of a failed test. It's the market saying, I tried, but the path isn't open. A smart money loves failed tests because they provide clarity. They also provide liquidity. At highs, a failed test lets the operators distribute to eager breakout traders. At lows, a failed test lets them accumulate from panicked sellers. This is one reason failed tests often precede strong reversals. The operators have already positioned themselves during the test. Once the crowd realizes the move was false, their reactions add fuel to the reversal. Breakout traders exit quickly, adding supply in a distribution environment. Breakdown traders cover their shorts abruptly, adding demand in an accumulation environment. The reversal accelerates not only because smart money changes direction, but because the public reacts to the failure emotionally. Another important aspect of failed tests is the speed and aggression of the reaction that follows. When a test fails, price often reverses swiftly. That speed tells you the truth. Once the test revealed the market's weakness, smart money didn't hesitate. They acted, and when they act, the market follows. Traders often describe these moments as fake outs, but they aren't fake at all. They are deliberate examinations. When the test reveals the weakness or absence of support, the composite operator moves decisively. What makes failed tests challenging is that they often look like breakouts or breakdowns at first glance. The unsuspecting trader sees price surpassing a high or dipping below a low and assumes continuation. But continuation requires commitment, volume, spread, follow through. A failed test has none of these qualities. If you train yourself to recognize these missing elements, you start seeing the failure forming even as price attempts the move. Failed tests also tell you about the underlying psychology of market participants. At highs, a failed test shows buyers are no longer confident, or at least no longer present in meaningful numbers. At lows, a failed test shows sellers are exhausted. Each failed test reveals what the crowd believes is happening and exposes how incorrect those beliefs can be. Smart money reads this psychology carefully because it gives them an advantage. They operate where others hesitate and accumulate or distribute where others misinterpret price action. When you begin to incorporate failed tests into your reading of structure, everything becomes clearer. You begin to anticipate potential reversals, not because you're guessing, but because the structural clues are already present. You see where effort is wasted, where conviction disappears, where buying or selling dries up, and where the operators step in quietly at the critical moment.